What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to go over one stock that we have talked about in the past, but it's now starting to look very, very attractive from a risk reward standpoint because of the fact that it's now starting to churn out very good profitability on an earnings per share and on a GAAP basis as well. So they reported earnings yesterday. I'm going to break this company down. We're going to take a look at the fundamentals and technicals. We'll talk a little bit about the intrinsic value as well. Hope you guys enjoy it and find it helpful. If you do, make sure that you drop a like. I would really appreciate it. Subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the members-only benefits, including the likes of Excel spreadsheets. We've got members-only private videos and Discord access. Everything's going to be included. There's 2 more weeks left if you want to join. 16% annual discount that expires at the end of this month, and 2 more spots left with the link down below. So the company that we are talking about today is going to be Palo Alto Networks, ticker symbol PANW, and it's been one of my favorite cybersecurity companies after Fortinet. Fortinet's been kind of like at the top because of profitability, consistency. The only thing that kind of holding me back with Palo Alto Networks has been the profitability, and the only thing that's been holding me back from Fortinet has been the valuation. So Fortinet is a stock that I do plan on eventually adding to the portfolio and maybe buying in the future, but of course at better valuations. It has dropped already. We've been talking about this stock for a very long time. It's already down over 45%, but obviously I am a cheapskate. I'm looking for under I think $45 was that level. I think closer to $40 is what I'm really paying attention to for Fortinet. So those right there are going to be some of the levels that I'm watching. But Palo Alto Networks, on the other hand, is also a stock in the cybersecurity space that has done incredibly well, pretty much trading at its all-time highs, right? So it has done really well with the overall trend. I mean, it's been consistently pushing higher, and it's now starting to trade a little bit sideways, but we'll talk a little bit about the valuation as well. And pre-market's down almost 5% at the moment. So going over to the revenues, very nice consistent growth in both revenues and profitability. You can see that the histograms are phenomenal, consistent growth, going from $600 million to almost $6.9 billion in operating income. More recently, in the last year, you'll notice has turned positive, right? So $387 million. Every single year prior to that has been negative for Palo Alto Network. Same thing is true with EBITDA. You can see that for the most part, negative EBITDA for the last couple of years, though, very nice consistent profitability and turning the corner. And shares outstanding have also increased, but not by a whole lot. So they have increased just by a little bit every single year. Now, when it comes to the margins, we're looking at over 73% gross margins, very strong EBITDA margins, quite reasonable actually, not super strong. I take that back. And net income margin at 6.36%. That has a lot of room for improvement if the operating leverage starts to kick in. For the company, we've got very nice free cash flow margins of 30%, return on common equity of 45%, and then return on capital and assets also at 3 to 5% for the company as well. So profitability grade and efficiency is very, very good. Excellent balance sheet. So $2.4 billion of cash with $2.33 billion of debt. So net debt sitting at just under $60 million for the company as well. And current and quick ratio is a little bit of concern. So short-term liquidity needs are not fulfilled, considering that they've got less than a 1 current ratio and quick ratio for the business. And debt to free cash flow also a little bit higher at over 6.23, which basically means that it would take a little bit over 6 years for them to clear out all the debt using free cash flow alone. We look for this number under 3. Now, valuations is still a bit of a concern because, the company's trading at a significantly high valuation on a GAAP basis, 113 and 200. Non-GAAP basis, we're looking at 48 to 52. Enterprise value to EBITDA at over 33, and on a trailing basis, 134. Price of sales, we're looking at 9 to 11, and price to cash flow, it's looking at over 23 to 28. So we are looking at a very expensive stock here. Now, just because it's expensive doesn't necessarily make it automatically a bad buying opportunity. And the reason for that is because it depends very much on the growth rate, right? The growth rate is what really determines how much investors are willing to pay for that company, right? And this right here, the P multiples, as we know, can compress fairly quickly if the earnings grow at over 100, 200, 300%. So if you take a look at the growth rate for the business, it's expected to grow from $5.34 to over $21 in the next 10 years. So if you plug in some of these numbers, so if you come down and I just plug in $5.34 here in 2024 all the way to $21.37, we are looking at a growth rate of 2033 of 16.6% over the next 10 years. But if I go to 2029, 1472, so 14 72, and that's going to be 2029. We're looking at a growth rate of over 22%, right? 22.5%. So we can safely assume a growth rate for Palo Alto Networks at close to 20% when we're doing our forecasting for this business. Revenue also expected to grow in the mid double digits to somewhat high double digits here, growing from $8 billion to over $24 billion, so 3x in the next 10 years. And this right here are the numbers, so 20% growth in total revenue year over year, 26% growth in RPOs, that's your remaining performance obligations. This is what the company reported yesterday. And then we got profitability metrics, so operating income up 64%, EPS up 66%, and GAAP net income was up $174 million on a year-over-year basis, and 20% growth year over year in adjusted free cash flows as well. So if you assume for, let's say, $1.5 billion in free cash flow for Palo Alto Networks, and we're going to plug in PANW here, we are looking at, let's say, 20% growth over the next 5 years, 12% discount rate, 3% terminal growth rate, 10% margin of safety. And yes, it would still be incredibly overvalued with a discounted cash flow model of $97 per share with an intrinsic value. Now, if you try to match these numbers with a reverse DCF, so let's just try to match these numbers and see what the growth rate needs to be in order for Palo Alto Networks to justify today's valuation. So let's just go to 40%. Let's do 45. Let's do 50%, and let's do 48. There we go. So 48% is most likely going to be that number for growth in free cash flows over the next 5 years in order for Palo Alto Networks to justify trading at $254 per share. That's really where it is. It's at closer to 243, so maybe it's going to be a little bit lower. It's 47, 46.5 is going to be that number close to. So depending on, considering where it's trading pre-market. So, but I don't think 47% is realistic. I don't think they're going to be able to grow 47% in free cash flows over the next 5 years. Maybe they could. Who knows? But our job is to make conservative assessments and build that margin of safety, right? We're not betting on the most optimistic scenario because if it doesn't play out, that can be dangerous, right? So we're not trying to make the most bull case scenario and create an optimistic, most bullish thesis to bet on that. But instead, we're trying to be as conservative as possible, as realistic as possible, and then see if it makes sense for us to look into that stock further. Now, this right here is going to be based on earnings. So if you come over to the guidance from the business for 2024, they're expecting total revenues of 8.15 to 8.2 billion and EPS of 540 and 553. So considering that it's trading at 254 or 245 right now divided by 550, we're looking at a 44.5 times earnings multiple on a non-GAAP basis for EPS, which actually is not bad. It's reasonable, but the earnings growth is not that strong. The earnings growth is closer to 20%, and the stock's trading at 44. So that's a PEG ratio of over 2, which obviously is significantly higher. Share count expected to be between 338 to 343 million. So if you do 550 times 340, we're looking at a profit number, $1.87 billion. So 1.870 is going to be that non-GAAP net income for the business. Growth rate, let's assume 20% and give them a multiple of 25. And now we are looking at our 12% discount rate here, 10% margin of safety, 2% dilution. We're looking at a fair value of closer to $173 based on a discounted earnings multiple model here, and also assigning a 25 times price to earnings multiple. 173 would mean 32% potential downside needed for the stock to be trading at its intrinsic value. And this right here is the sensitivity grid for Palo Alto Networks. So let me know your thoughts down in the comment section below. But for me, it's always been being conservative and right over the long term than being aggressive and wrong over the long term, because the latter can be very dangerous. The former builds that margin of safety, allows you to be more conservative in your approach. And even if things do go south, you've got at least some layer of protection with the margin of safety and the conservative estimates that you're making. Now, in the short term, prices are going to fluctuate. Prices are going to move up and down and sideways and all over the place. But short-term price volatility is not an indicator of long-term company performance, and that is something to always keep in mind. But for me, I think Palo Alto Network, anything sub 175 is something to consider, and that's going to be below, of course, those moving averages, below the 300 SMA as well. So this right here is the entire technical breakdown. I would love to most likely be looking at Palo Alto Networks in the 133 range. Since then, of course, it has gone up over 91, 92%. Year to date, the stock's up very, very nicely, 81% green. But support level right now is going to stay put at $213 next, with the resistance staying put at $257. all the way down to as low as those moving averages, and 133, 134 is going to somewhat be the level where I could see myself considering Palo Alto Networks at a better valuation. So hope you guys enjoyed this video, find it helpful. Make sure that you drop a like. Let me know your thoughts down in the comment section below, and what do you think about this company. As always, happy investing, and I'll see you all in the next video. Make sure that you do check out the links down below. There's a 16% annual discount for our Patreon until the end of November, with a couple more spots left. Happy investing. I'll see you all in the next video.